Good morning and welcome to today's webinar on the topic of a new era for gold, what to expect, as part of our thought leadership series. Today, we welcome Christoph, Eibl, CEO at Tiberius, Ross Norman, an independent analyst, and our moderator, Frederic Panizzutti, Managing Director at MKS Dubai. If you have any questions throughout this webinar, please email them to info@mks.ch. With that, I will now hand over to Frederic.
Well, thank you, Alex. Ladies, gentlemen, Chris, Ross, welcome today for our webinar. We look forward to having this discussion with you and the audience. When we first published our precious metal forecast in January of this year, we did not anticipate the widespread effect of COVID-19, and I guess no one really did. For several weeks, the world came to a near standstill. The impact on the world economies will be considerable. We believe it was necessary to review our forecast to better reflect the current extraordinary situation and its impact on the coming year. The IMF is projecting the global growth in 2020 at -3%, which is a 6% markdown in global growth compared to its January 2020 publication. The global stimulus package amounts as of June the 9th, 2020, a colossal $15 trillion. This is unprecedented and will have a long-term impact on the world economies. Over the medium term, this massive influx of capital could result in inflationary pressure and a loss of purchasing power in a negative global growth and negative interest rate context. Unemployment rate have very significantly increased globally. Geopolitical instability on various fronts in the Middle East will remain a key concern throughout 2020 and 2021. The trade war between US and China has again escalated and shall remain a major concern into next year. In the actual economical context, it is very likely that protectionism shall significantly increase over the coming month, as governments will be tempted to become more selfish and protect their own agenda rather than international corporations. These could, to some extent, negatively impact international relations and create new tensions between countries. All these factors combined prompted us to review our gold forecast. We now expect gold to hit an all-time high at $2,000 per ounce the next 12 months, and to average $1,850 per ounce. Today, we have with us two of the most prominent and respected precious metals market experts, Ross Norman and Chris Eibl, to debate the future of the gold market and its price. Now, Chris, Ross, we exposed the MKS view on the gold price future. We want to have yours. Maybe Ross, do you want to pave the way and share your view?
Yes, indeed. Thank you, first of all, if I may, to MKS for sponsoring and organising this event. We're very grateful to you. Christopher, looking where we stand, last year, in dollar terms, gold was up 18% on the year. This year, year to date, okay, we're only halfway through the year, we're up 15% in quite extraordinary times. Your forecast suggests we could see another 13% on top of what we've already had. I think it's modest in terms of the expectations for gold. I think we'll see the sort of numbers you're talking about a little sooner than you're indicating. You mentioned the figure there, $15 trillion stimulus. That's a massive number. Just to give you an example, if you wanted to count to 1 trillion, it'll take you 32,000 years. If you had to count to 15 trillion, it'll take you 500,000 years, 3 times longer than man's been on Earth. That's just one series of stimulus that's going on. It gives you a sense of scale. We talk billions, trillions, quadrillions, almost without any sense of the numbers behind it. And so the extent of QE that we're seeing is massive, and it's different to 2008. And I think that's the key point. 2008, we saw stimulus and significantly less than what we're having now, but it was effectively a digital cipher to the bottom line of bust banks. This is real money going into the economy. And I do think that once we end lockdown properly across the world, the velocity of money will rapidly rise. The quantum of money, M2, we've already seen, is growing exponentially, and we're seeing deglobalization factors. In short, it feels like we're going to swing from significant deflation to massive inflation in a short period of time. It corresponds to your argument, which is that the world is set for a period of inflation in the near term. When that is, I don't know. I suspect in a short few months' time. And with that in mind, and it echoes the comment you made, we're going to have a massive loss in purchasing power in our respective currencies. So I do agree with the general direction of what you're suggesting, but I think inflationary forces will be coming through much faster than you think, and much more powerfully than you think. If I could just hold it for one moment there. Currently, US 10-year Treasury bonds are negative yielding about 1.5%. You've got, inflation is at what? US inflation at 2.25%. You're losing about 1.5% on US Treasuries. I think that's probably what's driven gold to date. Is the negatively yielding Treasuries. Looking ahead, I think the market will be focused on inflation data, and I think that'll come through quite quickly. In short, I think you're right, but I think you're undercooking it slightly.
Okay. Thank you. Chris, are you with us? Chris?
I know we've had a bit of an issue with Chris coming online there.
Yeah, he was on and off. I think he's traveling, so I'm sure he will be with us shortly. So while we wait for Chris, Ross, you just mentioned inflation, so did we. You also mentioned that paper could lose some value. I mentioned the $15 trillion incentives that did flow into the market recently. Would you agree if I say that the stock market is overinflated because a lot of liquidity has reached into the market because interest rates are very low, and we probably see a setback once corporate results are published next year? Or do you disagree with that?
Yeah, no, I don't think there's a person out there that wouldn't disagree with the view that the stock market's got ahead of itself. It's pricing in a significant V-shaped recovery before there's any evidence of there being a return to normality. And what worries me more than anything else, I think, is the scale of the unemployment that's taking place. A number of companies are not only cutting back on staff for balance sheet reasons, they're using it as an excuse, I think, to scale back where they perhaps needed to. And when you have high unemployment, you have a loss of confidence within the system, particularly in relation to real estate and to stock markets, and therefore on spending. So I don't think people have really factored in many of the negative effects of these. I think there's an exuberance about the market which is unwarranted. It's way ahead of itself. And as we start to see earnings figures being reported, no question, the market will come back. I think if you look at the world today, and it's reflected in two other numbers I'll give you. One is debt to GDP ratios. The UK's just gone through 100%. We're at the kind of numbers where we were globally in the Second World War, and rarely does the world get to these kind of numbers. Look also at the gold-silver ratio. Rarely does it go above 100. And again, only during periods of war do we see that. The world is effectively on a wartime footing, if you like. And what corresponds to a wartime footing is that in the immediate aftermath of World War II, we saw inflation rising to 20%. Were that to be the case, then I think you could expect to see a galloping gold price. And typically with inflation rates of around the sort of numbers I'm indicating, you could see a galloping gold price of 20 to 40% a year compounding in a very short space of time. We're not there yet, but I think there's every indication to suggest that the world could be moving to that within the next 18 months. So pretty well within the time of your forecast.
Mm-hmm. So Ross, you're saying you see a very significant rise in global inflation rate. sooner than we do expect. You just mentioned a post-war figure, but what is your expectation? What sort of range would you see inflation toward the end of the year and next year?
Oof, that's a hard one. I'm not really an economist, so probably anyone who's listening onto this presentation will have as strong a good a view as I have on that. But currently, as I say, US inflation rate's 2.25%. Credit Suisse did some research on gold's relationship to inflation, and what it showed, and I think it's been corroborated by other banks, is that when you get through 3%, there's an inflection moment, an inflection point. It gets onto everyone's radar. When you've got a 3% plus inflation rate, people are conscious about it, and then therefore gold goes from watching the dollar, as it used to, currently negative rates, and on to inflation. And I think at 3% we get that. So I think we'll be moving well through the 3% level, suggesting with US Treasuries where we are, you could be losing 2 or 3% conversely. And gold, of course, does very well in that environment. Inflation estimates for 12, 18 months' time, I don't know, 6%, 7%, maybe not back to the double digits we saw in the mid-80s, maybe not. But certainly you've got to see a significant increase. I don't know what the number is.
Okay, no, that's interesting, because looking at the GDP growth, which is now estimated at -3% by the IMF, looking at your forecast on the inflation rate between, say, 3% and 6%, that's going to be quite a loss of purchasing power for everyone. So that should help gold to keep its role as an asset of choice and to keep or maintain purchasing power against main currencies, right?
Yes. Well, the issue you may have is not the price of gold, but the availability of gold. Now,
I was going to come to that, but please go ahead.
We've seen it 3 times now in the last 10 years where we had a galloping gold price, but you can't get it. What I mean by that, yes, of course you can. You can buy an ETF, and there are other institutions like Bullion Vault where you can buy gold through a mechanism where you're buying parts of a 400-ounce bar. But for ordinary investors who might be buying kilo bars, coins, and bars, there's been a massive shortage because of the supply chain shock. And we've had that before. You have to consider that if you want to buy insurance, you've got to buy it before you think you need it. There's no point buying insurance on a house which is on fire. Once the lifeboat's gone, it's gone. And I think if we have the kind of scenario, I'm not trying to panic investors to buy gold, rapidly. I don't have any skin in the game. I'm just an analyst, independent analyst. But we saw spreads widening in the professional market. We saw the EFP and the professional, the difference between the spot price and the futures market massively blowing out to 7%. Bid offer spread 7%. A lack of availability of coins in Europe going on for months. So all I would suggest is if you feel that a negative scenario is coming, you're better off getting it before you think you need it.
Now, I fully agree with you, Ross. And it's good you mentioned physical availability. I mean, the last couple of months, gold was available. It was just not in the right location at the right moment. So it was more like some sort of logistics bottleneck and restriction rather than the availability of gold. But this said, we have seen a reversed flow of gold this year again, the same we saw during the last crisis. Typically, gold flows from the west to the east. That's a typical flow of gold. And then when gold goes up very high, usually we get some gold back as scrap to take profits. But the last couple of months, we have seen very significant amounts of gold flowing from the east to the west, right? And it looks like these investors that were looking to buy this gold in the west are still holding on it. The Southeast Asian and Asian demand has yet to pick up. What do you think will happen once the west is a buyer and the east is a buyer? Which is a situation we have very rarely seen, right? Having both ends of the world being big buyers at the same time. What do you make out of it? What do you think? Do you think gold will be available or enough available to answer short-term demand on both ends of the world?
Well, the Asian market is notoriously price sensitive, and with this rapid rise in the gold prices we've seen, a tailing off of demand in India and China, compensated for by massive buying from the ETF buyer, predominantly European and US institutions. I believe that this month, month to date, we've seen 62 tons of gold buying. Year to date, somewhere in the region of 570 tons year to date, beating previous years with only half a year gone. It's off the scale, the ETF buying, and that comes on the top of central bank buying, again, the best for 70 years. So you're right, we've had this massive seismic shift from being a India, China, gold buying centric world to being a Western institutional buyer and a central bank buyer. I suspect that the Asian market needs to get used to the higher number. And it does seem there's evidence that the Chinese and Indian demand is now coming through. India, interestingly enough, gold is up against a big figure change. It's just south of 50,000 rupees for a 10-gram bar. So for a prospective investor, they've got to get through that mental hurdle of the gold price starting with a 5, not a 4. And that tends to provide a bit of resistance, that technical level, if you like. People are reluctant to get in on the market at that level. But when they recognize, when you get an inelastic gold price, which is to say buying on gold price strength, not selling into price strength, then I think you get a massive buying spree, and then you've got a real issue about availability of gold. Looking ahead, and I'm moving the conversation into a different space here, there was a World Gold Council report that came out recently that showed that there's been no major gold discoveries for 3 years. And the rate of replacement of gold from big gold being mined is cratering, falling off a cliff. Some years from now, and this is interesting perhaps for the longer term investor, again, you're going to have an issue of the ability to source gold, not a question of price, but the ability to get the stuff. I'm not looking to scare them, I'm just pointing out the very simple fact, we've increased the amount of exploration spent significantly around the world, but we're not getting new mine discoveries coming through. And that's been the case for the best part of 10 years, and 3 years has been a long period of time without any major discoveries. It is a concern, and if you're looking for a 5-10 year view, I don't know, $5,000 gold price, 10,000, I don't know. It could be off the scale. It's a long period of time, and there are many variables within that. So going back to Asia, yeah, you're right. It's with the world shifted dramatically from an Eastern-centric market, gold flowing through refineries such as your own, converting scrap jewelry that people would sell into a kilo bar market, local Hong Kong, local Singapore, into China, 4/9s. It's now swung the other way. A lot of it going on to COMEX. And of course, London and COMEX have had a bit of a ding-dong, as you may have seen in the last few months, and dislocation between those markets, as you'll have observed as well.
Okay, well, thanks, Ross. You just mentioned some quite big figures for the coming few years, but where do you see the gold price within the next 12 months? I mean, you seem to say that our forecast at 2000 seem to be too conservative for you. So where do you see gold hitting a new high within the next 12 months from now?
Nothing like
I'm sure everyone is interested to know your forecast on gold.
Well, back in January when we did our forecasts, my average was higher than the entire range of every other analyst in the table. My average was to gold to average this year 1750, which is roughly where we are now. And actually, I think we'll end up about that number for what it's worth, around 1750, because we had a slow start to the year. The last 9 weeks, gold has been flatlining. But go back to your question, I did say back in January that gold would hit an all-time high. And just to remind ourselves, that was $1,922 on the 6th of September 2011. I said we hit it in the third quarter this year, maybe fourth quarter. But I think we'll be north of 2,000 at year end, assuming markets continue along the same vein. I guess what will be the deciding factor is how these things evolve. Gone are the days when you used to be able to forecast gold by looking at gold mine production and an estimate for the dollar, and you'd run a macro and it would throw out a number. Now you're in a world where it's driven by the madness of crowds, and it's very difficult. And literally, the market can pivot on a tweet, and an announcement hard to forecast. So in short, I think that it's very, very difficult to forecast markets in the current environment, and it's a fool, perhaps, count me as one, who'll do so. But all I know is that the markets are very vulnerable. The financial markets are very vulnerable. The chance of a systemic default are significant. What I would end this part by saying is anyone listening in, is if you had to ask yourself, what are the chances of there being another major catastrophe financially? In other words, a run on inflation, another epic collapse in equities. We had a 40% fall. Could we see a 70% fall like we had in the 1930s? If you're expecting that, you know, a W-shape market, not a V-shape, what are the chances of that? Ask yourself, is it 1 in 5, 1 in 10, 1 in 20? If it's 1 in 10, then there's your allocation to gold. If it's 1 in 10, put 10% into gold. If you think it's 1 in 5, 20% into gold. Nothing more sophisticated than that. If you think the system is vulnerable, I don't think you and I need to be too clever about pointing out what it is that's going to trigger that default, because the reality is we don't know. The point is, you know the system is vulnerable. It can be almost anything. And that's your allocation. I don't think you need to be cleverer than that.
So Ross, I'm sure the audience will try to think how, you know, what they expect the chances are for this to happen. But what are your odds? 1 out of 10, 1 out of 20, 1 out of 5?
Well, I'm an optimist, and you know, I believe in hoping for the best, preparing for the worst. We are quite good at managing to dodge bullets, and you hear Mario Draghi saying whatever it takes, and the US are now echoing the same. Yes, I worry. I look at the scale of debt, and I'm thinking it's getting to the point where statistically, mathematically, it's impossible to pay down. So, although I do believe in man's ability to create solutions to difficult problems, whether it's environmental, whatever it happens to be, I'm beginning to fear increasingly that the scale of debt is becoming impossible without a reset of some description. A reset basically means not necessarily social disorder, but a new currency, a new way of looking at money. And maybe this is a new subject for you, looking at digital currencies, not fiat currencies that we're familiar with. Now, you guys are involved in that space, aren't you, Frederic? In
Yes,
the world.
Yes.
Give us a quick view on that.
Well, no, generally speaking, I do agree with you that, I mean, even though gold has, to a certain extent, been considered as a currency for the last centuries, it also remained a commodity. So it had some sort of dual role. But over the recent few years, and especially over the last few months, I think that gold's role as a currency will dramatically increase as people are looking for, let's say, a safer way to hold money, right? And if we estimate that there are some possible chances of having a big systemic failure or risk, which is a possibility, because as you mentioned before, leaders have all reacted saying, okay, we'll do whatever it takes now, and they have done it. But that will come at a cost tomorrow, right? What is done today will come at a long-term cost tomorrow. And yes, I believe that gold as a currency, gold as a digital currency also, which allows you to make easy transfers, to make easy payments, and to have a full backup in the form of physical gold, is certainly one of the gold assets that could be of interest in the current situations and for the coming few years. Yes, indeed. Yes, thanks for mentioning that, Ross. But yes, I think you're right.
I mean, I think that we're not in a moment of seismic changing in the gold price. I think we're also at a change in terms of the institutions who are playing a role in gold and the methodologies around it. Probably, I mean, there are many people out there launching gold-backed stable coins and gold-backed currencies of various sorts. The reality is they haven't got too much momentum at this stage. I suspect that once the settlement and clearing of gold is done through using the blockchain, and there are initiatives around that, the ability to trade gold professionally is smoothed. I think then you've got the infrastructure behind gold to allow it to become a currency, and then you have the ability for you and I, for example, Frederic, to exchange gold, peer-to-peer transfer of value, not to your bank, but I confer it to you. And many people worry about fiat currencies not being backed by gold. I don't think you should worry. I mean, the point is you can do it for yourself. You can back your own self by gold by owning some. Effectively, your savings can be gold denominated, if you like, and you can spend that gold. And again, there are some challenger banks, such as Revolut, who've launched gold accounts for you to hold your value, and Glint, hold your value as gold, and you can spend it. The nice thing is gold is going full circle. It's coming back to its real role as money, real money. But to do that, and it has a 5,000-year track record as a store of value, but to become a real currency, you need to have it more transferable. It needs to be, and to do that, it needs to be digitized. It needs to be tokenized. We're getting there, and people are reluctant to perhaps fully engage with that digitization of hard assets, but it's coming. And I think that people are moving that way, and the falling in credibility of fiat currencies is accelerating that process. We're moving to a digital world, and I think we'll see new players in gold, whether it's an eBay, Facebook, Amazon, I don't know, whether it's a challenger bank, probably. And I think that the way we trade gold will be changed very, very much in the next 5 years, and it will be for the better. I think new channels will be opened up to allow people to access gold in whole new ways.
Okay, well, thanks a lot, Ross. I think we will soon move to the Q&A session. We got a few interesting questions for you. So before we move to questions, maybe would you like to make any closing remark or anything you would like to add to what you just said?
I don't disagree with your general gist of your forecast, Frederic, in terms of the points you make, and I'm glad that you didn't pick up on COVID as the main driver for why gold's moving higher. And most newswires do. They look at second wave. They're on this cresting fear story. I don't think fear is the best reason for buying gold. I think you buy it for a quiet, slow, rational reason. You look at the global economy and think, yeah, I better put some away. Don't be driven by fear. Don't be driven by COVID stories. And your forecast reflects that. Generally speaking, the trend is good. We've come through a 9-week, pretty dull period for gold. Get ourselves through that 1765 level. We were just shy of it yesterday. We're then at an 8-year high. And then we get onto the radar of the asset allocators. We're just a moment from really being on the radar again of some interesting moments in time.
Well, thanks a lot, Ross. So now we can move to some of the questions we received. I think the first one will be very tough on you. Well, it would be on me. Ross, how long do you estimate the economic instability and crisis to last?
Wow. Well, anyone listening to this presentation will have, as I say, as good a view as I on this. How long will it last for? Well, gold typically sees cycles, and we saw the beginning of one in 2000, driven by its own fundamentals. And we then had a global financial crisis in about 2008. And some would argue that that issue is still with us, by the way, but in a bigger way. Typically, these things don't go away in a hurry. I would imagine we're in for a 5-8 year cycle. And I think we're at the beginning of it. Gold did 18% last year. I think this year we'll do 20-something%. And I think we'll have a 20 or so % increase in gold over a few years to come while this issue continues. How long for? I don't know. I think we're early stages, maybe another 3 to 5 years. What comes next, goodness knows.
Okay, well, thank you. It was quite a tough question to answer, but you answered it well. We have another question actually, which is not on gold, but on silver, which can also be a topic today. Ross, silver has been neglected in the first few months of the year, but catch back to a certain extent. What is your view on silver?
Yeah, and Frederic, you had a forecast, I think, of $21, I think, in your silver forecast.
Yes, with a high of $23 an ounce. Yeah.
I think, looking at your forecast also, you had silver performing roughly in parallel with gold. In other words, I think the gold-silver ratio ended up at about 96 to memory. Silver, if you want to look at silver, look at gold in a way. Look at the company it keeps. We've just come down from a gold-silver ratio of 126. Unprecedented. In other words, it suggests that silver is an absolute steal or gold's overpriced, and I think it's the former. Silver's the unusual one. I always regard silver like the intern at the Christmas party, quiet during the year, and then kind of might be inclined to have a glass of wine too many and disgrace itself. That's what silver does. It suddenly, quietly, like a Labrador, follows gold around with little character. Sorry if you're a Labrador owner, and then suddenly it goes berserk. And often at moments like this, where you look at silver, because silver just might give the lie to where gold's going. It might give a good indication. Suddenly silver does that. It goes a bit crazy, and it feels like it's brewing for that. The gold-silver ratio has come down to 98 at the current time, suggesting that silver's picking up some momentum. But like gold, it's struggling with technical resistance levels. It doesn't have the momentum yet. If silver could push through its critical levels, it could drag gold through that 1765 level. It wouldn't surprise me if it was reversed, the relationship in that way, and you see your $21 as you're suggesting, Frederic. So silver, if you want to know what's happening to gold, look at silver. Technically speaking, you know, looking at the last millennium, over the last 100 years, the ratio is typically 45 to 1. Currently we're 98 to 1. It should follow gold is overpriced relative to silver by silver. I would wait for those important technical levels to be broken. Gold through 1765. Funny enough, silver's got a similar resistance level. I think it's $17.80 or so. Convincingly through $18. I think silver might lead gold, and then we're off to the races.
That's quite interesting. Silver leading gold, but yeah, why not? I think we just have time for one last question, even though we are a bit over time. But I think it's also a very interesting question. Ross, once they will announce that a stable and effective cure and vaccination is found for COVID-19, would it be possible to see gold undergoing a retracement and move lower?
No.
That was a very clear answer.
I mean, we've all got COVID, and we're all closet epidemiologists now, or would like to claim that we are. We read about it. I guess, and like most of us, swung from absolute abject fear to thinking, get on with it. It's just an influenza. This last weekend, I had I won't say who he is, a consultant surgeon from a London hospital with us for the weekend. And I don't mind sharing with you that he did medicine and law in parallel at Cambridge University. He's no fool. He shared with me, look, get on with your life. COVID will come, it will go. There is a degree of scaremongering, and it has some unusual aspects to it. This isn't a COVID presentation, I accept that. But I think generally speaking, it's overcooked, the negative aspects of it. There are treatments already that seem to work. And most importantly of all, gold's not following COVID. It's following some of the consequences of COVID, economically speaking, and the issues around it, but it's not cresting on a fear wave, and nor should you.
I fully agree with you, Ross. COVID is a temporary problem,
Phenomenon.
a big problem, temporary, but the impact on the economies and the steps that have been taken to keep the economies afloat, that will be the lasting impact that might drive precious metals, gold and silver leading, as you just said. So I think we're a bit over time, so we will. That was our last question. Ross, thank you very much. That was a very interesting insight. Thanks for sharing your view. And yes.
Sorry we didn't have Christoph here. I know that it's a shame to have lost him for this presentation. For those that would like to have heard from him, he's a very bright guy. We're poorer for not having you, Christoph, on this presentation. I know he has some technical problems, but I may also thank MKS again for putting this together, and especially Frederic and Alex.
Thank you very much, Ross. Alex?
Yes, thank you very much.
I hand the session back to you.
Thank you very much, everyone, for joining this session. Thank you obviously to our speakers, Ross, Chris, who unfortunately couldn't join, and Frederic for this very insightful session. And do stay tuned for more upcoming thought leadership webinars. Thank you very much, everyone, and have a wonderful day.
Thank you, everyone. Thank you very much, Ross.
Well done. Thank you.
Goodbye. Thank you.